bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the October 1st, 2024 podcast. As those of you watching on YouTube can see, I'm here today with my partner, Tony Grappone. Our regular audience can guess what that means. Yes, this is another installment in our Renewable Energy Tax Credit Finance series. This is episode 11 of that series, to be precise. We launched this series last year to keep you updated on renewable energy tax credit financing news, trends, and strategies. We do have a playlist of all of the episodes in this energy series. It's on YouTube, and I do encourage you to check it out on our Novogradac channel. I also encourage you to refer it to your colleagues. I will share the relevant links to that playlist in today's episode show notes. Now, let's turn to our topic today. This is a topic that's important to everyone in the renewable energy industry. It's the do's and don'ts of clean energy financial forecasts. Now, financial forecasts are a fundamental part of financing and developing any clean energy facility. They're particularly crucial for evaluating investor and sponsor returns. We'll discuss the key do's and don'ts at each major step in the financial forecast process, from construction and operations to debt equity sizing and tax and cash benefit analysis. We're going to share a plethora of useful tips, so I do encourage you to go back and review our show notes transcript to identify the various tips we're discussing. You'll find our show notes at www.novoco.com/podcast. Now, without further ado, if you're ready, let's get started. Tony, welcome back to Tax Credit Tuesday.
Thanks, Mike. It's great to be back.
You're a regular guest on the podcast with this renewable energy series, and you were just on the show a couple of times in September as part of a panel that we did discussing tax credit equity pricing and other relevant factors. Now, apart from your participation on this show, you're also very well known in a number of other capacities around the renewable energy community. Not only do you serve many renewable energy clients, you're also a frequent speaker at industry events, and you do help co-lead the Novogradac Renewable Energy Working Group. Now, as a way of further introduction, please share with our audience some of the services you provide to Novogradac clients.
Great. Thanks, Mike. Yeah, so I oversee 3 different silos of services. One silo is geared towards what I call transaction advisory services. That's usually financial forecasting, cost segregations, and related consulting services. The second silo deals with financial statement audit services, compilations, reviews, and agreed upon procedures engagements. And then the third silo deals with preparing tax returns or other kind of tax compliance related issues.
Great. Thank you for that great introduction. And now let's talk about financial forecasts. Financial forecasts are useful for every organization across all sectors of the economy. And we at Novogradac work with them quite extensively in the various tax credit areas that we work. But today we're going to talk specifically about clean energy financial forecasts. So Tony, if you could describe the key purposes of a financial forecast for clean energy facilities.
Sure. Thanks. Right. So renewable energy forecasts, they track the life cycle of an investment deal. Okay. They usually start at the first phase is usually when the developer is trying to win an offtake agreement or a power purchase agreement. So initially the model is fairly simple and it's really just geared towards the developer trying to figure out how much they need to sell the power for in order to propose a PPA rate or an offtake rate pursuant to an RFP. After that, the next phase gets into construction costs. We'll talk about all these issues in more detail throughout the podcast. But the next phase of the model involves construction debt sizing and figuring out how the developer is going to pay for construction costs. After that, the next phase gets into operations. And during that phase, they're trying to figure out how much permanent debt they can support and how much tax equity they can potentially raise. And then all these things are done in the model to try and figure out how much the sponsor needs to invest and how much money the sponsor can make off of the deal. Ultimately, once all the sources of financing have been raised, the model is used for tracking purposes to help monitor the debt and equity performance throughout the life cycle of the deal. And then lastly, you can also use the model to assist with gap financial reporting needs.
So, what would you say the key elements of the clean energy financial forecast are?
Great. Exactly. So, with any good model, the output results are usually only as good as the inputs that create the output. And when I'm talking about inputs or elements, I'm talking about the assumptions that are used to create the results. And so you really want a as complete and accurate set of assumptions as you can possibly use to help ensure that the forecasted results are as indicative as possible as how the facility is going to economically perform.
Thank you for that. When I think of the financial forecast, I always think of it's at its very base, cash flow based over a period of time. And the time depends upon one of those sort of key assumptions. And it's sort of cash flow based. So at some level, it's a cash flow model and lots of schedules to track all the cash flows. And then once you have all of that, and it's in some sense a closed system, it all balances out. Then you have to then take all those cash flows and identify the tax considerations associated with the timing of income and loss. And obviously, as part of that, the tax credits. And then there's also the gap considerations, the public reporting of the income and loss from the activity during the term for any of the public entities or any of the entities involved in the transaction and in ownership that are reporting or calculating their earnings on a gap basis. And there is like I say, it's a closed system. And in preparing for the podcast, you and I talked about how when clients have come to us with models they've constructed themselves, sometimes they don't fully appreciate the closed system, the checks and balances built into the forecast, which is pretty important. But the other thing I wanted to also emphasize is you've heard me say this before internally at Novogradac, that the only thing you really know about a forecast is that's not going to happen exactly that way. But you do want it to be as predictive and indicative of the expected performance as possible, which is founded in, as you pointed out, getting very accurate assumptions. So
Yeah, I really like how you broke all that down, by the way. And so you talked about the closed system. And when you say closed system, I kind of relate that to hey, look, this is project finance work. So a
right,
closed system meaning we're dealing with one project financing here. And then the checks and balances, that kind of reminds me of the balance sheet approach that we take to the model. And then you also alluded to cash flow. So many of our developers, they really think about this on a cash flow, cash basis standpoint. So I love how you sort of broke that down. Obviously, you can relate to this as somebody who's worked in the tax credit industry for your whole entire career and oversee a very large accounting firm that specializes in tax credit work. So well
yes,
said.
yes,
Yeah,
35 years at Novogradac, 40 years overall.
that's right.
So embedded in everything we just discussed are a number of do's and don'ts. But let's now discuss your top tips for sponsors and developers as they approach each step in the development process. And let's start with construction considerations. What are some of your main do's and don'ts in terms of the construction considerations involved in developing a financial forecast?
Yep. Great. So my tips on the construction phase will ultimately sound kind of familiar too when we get to the operating phase. And it's really about, again, it comes back to that complete and accurate set of assumptions. When we think of renewable energy forecasts, there's really kind of two models here. You've got sort of the client side of the model, and then you've got the sort of like the Novogradac tax side of the model. When you think of the client side of the model, one of the don'ts is just don't be too general. Don't be too high level. A lot of times we get a client model, it will sort of budget out construction costs expressed as a cost per megawatt. And they won't necessarily take the time to unpack that cost per megawatt to show the line item detail that shines a light on some of the more unique costs specific to that maybe geographic area or that type of technology. Some examples include things like interconnection costs, which can really vary from site to site. Other examples include things like labor costs and apprenticeship related costs. These days in the clean energy industry, most facilities need to qualify for prevailing wage and apprenticeship. Well, those labor weights are very unique to the market that you're in. So again, getting that developer to think beyond just a high level cost per watt estimate and unpack that into more line item relevant detail that's more specific to the facility, technology, market, etc.
So thank you for that. Uh, once we went through and had our estimate the cost of construction during that development phase, so those are the big picture uses. You then convert to an operations phase. So share some of your do's and don'ts in terms of estimating the operation results for purposes of the financial forecast.
Great. So continuing along the lines of just getting away from being too general and high level and more granular. So a lot of client models that we get will forecast operations on an annualized basis as opposed to something like quarterly or monthly. In renewable energy, you really want to be able to forecast operations on a monthly basis. Why? Because not only do equity investors oftentimes underwrite returns on a monthly basis, but as we'll talk about in a bit on the debt size, understanding monthly energy production, revenues, and operating expenses is critical to sizing permanent debt. And we'll talk about that in more detail in a bit. So just getting away from annualized results, getting into more detailed monthly results is very important. And then oftentimes a client will just project like a total number for operating expenses without thinking through what is within that just operating expense number. When I review financial forecasts and financial statement audits and tax returns, I'm always looking for certain core operating expenses. And those core operating expenses that I expect to see on every deal are taxes, insurance, right? What business can operate without incurring some form of tax or insurance? O&M or repairs and maintenance, site lease expense. Almost every renewable energy facility leases its land as opposed to buying land. So site lease expense, general administrative costs, annual audits and tax returns. And then lastly, some form of utility costs. Those are critical. Those again, we find them on every deal. Oftentimes a developer will say, well, I'm subject to, you don't understand, we don't have property taxes because this facility is located in an area that enjoys a renewable energy property tax exemption. That may be the case, but maybe the town might require some kind of payment in lieu of tax arrangement. So have you thought about that? And then lastly, what about state and local taxes? A lot of times our clients think of these models more on a federal tax basis
Yeah.
level, not necessarily
Yes.
state and local tax basis. We have a SALT team here at the firm, and that SALT stands for state and local tax. We have a SALT team here at the firm, and they can help clients really figure out what that state and local tax profile looks like as well to make sure that make sure clients don't overlook an important and significant operating expense assumption related to state and local taxes.
Now, I'm glad you pointed out the state and local tax element of that, because that is one, if you're working nationally, you cannot appreciate how that can vary at the local level. A good example of the various ways in which your costs can vary at the local level. So we've got the estimate of the overall uses during the construction phase. Now we've got an estimate of the operating income and expenses on a monthly basis. Now let's move on to the sources side. How are we going to pay for the construction phase to the point of operations? And that involves permanent debt and cash equity sizing. What are your financial tips or do's and don'ts with respect to debt and equity sizing?
Great. So in terms of permanent debt sizing, you want to consider market rates for interest, but also debt service coverage ratios. And you also want to understand that depending on the lender might want to see the operations either projected on a P50 basis or a P90 basis. And sometimes they expect a toggle to switch back and forth between P50 and P90. The P50 or P90 scenario can result in different debt service coverage ratios, interest rates, and even what portion of the loan might be considered recourse or non-recourse. Okay. And again, that's where, when it comes to debt service coverage ratios, again, and we'll talk about this in a follow-on point to this, but monthly revenues and monthly NOI for debt service coverage ratio analysis is super important for renewable energy facilities.
And you say monthly, and maybe unpack that a bit in terms of the seasonality here. Because when you think of residential rental housing or office and the rest, you don't really think about the necessity. You have to deal with lease up and things of that nature and try to estimate what the run rates are, but you don't think about them being seasonal. Maybe move in and move outs could be seasonal, but to the most part, you don't think of seasonal revenue. And obviously, to someone who's very experienced in renewable energy, it's not such a surprise, but there are, a large number of clean energy revenue sources that are seasonal. So share the importance of that.
Sure, I'll talk about it in the context of solar, but you could also talk about it, in terms, but it also applies to wind, even battery storage. So when it comes, but we'll focus on solar. So in the summertime, the sun is up for a longer portion of the day than it is in the wintertime. So you get more sunlight exposure during the summer hours, which leads to more energy production and more electricity sales. But also because the sun during the summertime is higher in the sky, you're getting more direct sunlight angled to the panels, meaning you're also leading to more energy production in the summertime. This means that the facility is generating more net operating income. And so many lenders in renewable energy are used to what we call debt sculpting. And what that means is, let's say the lender requires, say, a 1.3 debt service coverage ratio. Well, during the summer, if you take the net operating income that's higher in the summer and divide that by 1.3, you'll get to a higher principal and interest payment on the loan than you would, say, in the wintertime when you've got less production and less NOI. And so that's, again, another reminder why sort of like monthly NOI forecasting is so critical, because when you get into the debt underwriting phase, your lender is really going to expect to underwrite that seasonality and the debt sculpting on a monthly or at least quarterly basis. And then I touched on P50 and P90. For those of you who aren't familiar with that, those
Please
are
unpack that.
right. And so those deal with probability scenarios. So P50, you want to think about it like like a 50% chance that the facility will generate that amount of energy production. And a P90 scenario is more conservative. It's more of a 90% likelihood that the facility will generate that amount of production. And so independent engineers are usually the third party that sort of assesses the energy production from a facility. They evaluate the major components, the location of the facility, how it's installed, et cetera, and that helps them reach conclusions in terms of how much energy should be produced on, say, a P50 or P90 basis. If you're a lender and you're underwriting to a P50 scenario, again, that's your more optimistic, bullish energy production scenario and less likely to happen. So naturally, the lender's going to have a higher debt service coverage ratio for P50 and probably a higher interest rate as well. P90, lower debt service coverage ratio, maybe even a better interest rate, and you might even get more non-recourse financing on a P90 scenario.
So let's now turn to the fourth element or phase. We've talked about the construction phase and estimating those costs. We've talked about operations. We've talked about the debt and some of the sort of cash equity. But this fourth phase has to do with the tax benefit analysis. And in preparing for the podcast, you and I discussed how many project sponsors aren't sure how much effort they should put into developing a tax benefit analysis for their investor, as they often believe the investor themselves are going to do that analysis. Please share your recommendations on how sponsors should navigate and to what degree they should be preparing their own tax benefit analysis.
Sure. Yeah. So we always appreciate it when our clients do a thoughtful analysis on all aspects of the model, right? Because means they're more aware, more in tune, et cetera. However, one thing I just discourage clients from doing or sponsors from doing is trying to get too married to what they perceive the tax equity investor benefits look like. The the tax benefits can really vary depending on the type of structure that's used or even the type of investor that you go with. Some investors are subject to things like the at risk rules or the passive activity rules. Some investors are limited in terms of how much tax liability they can offset that year based off carry forwards, carrybacks, et cetera. And so I just wouldn't assume that, I think it's unfair to assume too much about how much benefits an investor can use on your deal per year. There's capital account issues that impact allocations. There's inside basis issues, outside basis issues. There's all kinds of things that get impacted here. Plus, depending on the time of year you place the facility in service can have a big impact on how much first year depreciation benefits are available. Okay. depending on the tax return filing profile of the deal, could impact those first year loss benefits as well. So again, I like it when clients are thoughtful and they're able to gain a good thought out impression of the potential tax benefits. Just don't get too married to them or too handcuffed to what you think those results will be.
So I'm glad you emphasize not getting married to or handcuffed to this analysis, but also emphasize the benefits of the sponsor, engaging in the process of developing an analysis. And I find it super helpful from a negotiations perspective with your investor and just investor selection in general. And it also, helps analyze the relative benefits. Tax equity, when you look at your various capital stacks, will be one on the higher end of the cost of capital. So the timing in terms of when you bring that capital in and the rest, this analysis can be really helpful. And this analysis also can help with the next item I wanted to chat with you about. And that has to do with the sponsor returns and the financial model. Once you went through and estimated the construction costs and your operating, income and expense and some exit, as well as the sources of capital, both debt and equity to fund, you end up with which in some ways is the plug, and that's the sponsor benefits and returns. The sponsor benefits and return schedule is basically showing the capital a sponsor may have to put in terms of equity and the rest, and then showing what cash flow is getting generated that can go to the sponsor in terms of developer fee, operating cash flow, residual, and the like. So what are some of the do's and don'ts in calculating sponsor benefits and returns?
Right. So you alluded to it, right? It's the sponsor. Oftentimes the sponsor investment and profit is sort of a plug. We solve for that. Okay. So, and how do we solve for that? We solve for that by helping the client figure out how much they could raise from all the other sources. All the other sources are the construction debt, it's the permanent debt, it's the tax equity. Those are your other sources of financing available. We try to work with our clients to maximize these benefits, especially tax benefits, in a way that gets the most value out of those tax credits and deductions, but also in a manner that complies with various tax rules and regulations. Okay. And then after we've helped our clients kind of maximize all their other sources of capital, that gets you to their investment and the returns and the profits that they'll make off of that investment. And so you kind of figure out that portion along the way, but at the very end of the day, it's kind of their return gets figured out sort of last based off of what the other financiers put in and get back in terms of benefits. Yeah. And so, and along the way, there's a lot of complicated Excel work that needs to get done. And so I alluded to debt sculpting and P50 and P90 and toggles and scenarios. And so one of the other things that we can do, not only do we help clients maximize tax benefits in a way that complies with rules and regulations, but we can also help build in that sophisticated Excel logic to run these different scenarios, upsides, downsides, P50, P90, you name it. And then with sponsors, we help them run a variety of scenarios for them too. Some sponsors are thinking they will get to the end of the tax recapture period and they are thinking about buying out the investor. Other times, the sponsor might be thinking they might be doing a deal where they're actually planning on staying in with that tax equity partner for the whole duration of the economic useful life of the deal. Sometimes the sponsor's not sure. And so they want to run multiple different scenarios to figure out what's financially the most advantageous to them. And so we oftentimes can run multiple scenarios, upsides, downsides, short term, long term, et cetera.
Yeah, I find it super useful at, these schedules to try to assess for the sponsor what the impact on their cash flow in terms of timing and funding needs and the rest based upon the various assumptions you've made in other parts of the forecasting process. So Tony, I appreciate you sharing these valuable insights. You've given a great overview of financial forecasts for renewable and clean energy facilities. To our audience, let me say, if you're a project sponsor, developer, or investor, and you'd like to get more in-depth help for a specific facility that you're working on, I encourage you to contact Tony or another Novogradac renewable energy partner. I will share Tony's contact information in today's show notes. But for those of you who are just listening to the podcast, His email is tony.grappone@novoco.com. That's Tony, Tony, period, Grappone, Grappone. And I do hope that you'll come and say hi to Tony and me at the Novogradac 2024 Fall Renewable Energy Tax Credit Conference. Tony is the chair of the conference, and I'll be leading the Washington Report panel on day one. And this is a particularly special renewable energy conference. It will be held in Washington, D.C., and it's going to be held on the Thursday and Friday of election week. That's right. The election is on November 5th, Tuesday, and the full conference is later that week, the 7th and 8th, Thursday and Friday. And right after Election Day on Wednesday, November 6th, we also have a pre-conference project finance primer workshop. Now, I'm really looking forward to this Washington Report panel. Right now, in this panel and discussions I've been sharing across the country, I'm very focused on the various implications for tax credit finance of a Democratic sweep or Republican sweep or divided government. And that week, this will be the first Washington Report panel that I participate in, where we'll know at least some of the election results. I'm hopeful that we'll know who the president is. I'm also hopeful that we'll know that control of the Senate and the House. Now, it's quite possible we'll know control of the House if it's particularly close, which we expect it to be. California and other states can be several weeks in getting the final canvass on really close races. So we may not know fully whether or not there's a Democratic sweep, Republican sweep, or divided government, but there's a good chance we'll know some of those factors, and it'll be great to start talking and narrowing some of the potentialities of the election results. So I do encourage you to join us. Come say hi to Tony and me, as well as learn, network, and share your thoughts with others at the conference.
I can't wait. I love it. I've been sharing this renewable energy conference in DC for probably something like 15 or 16 years. It typically does come right on the heels of a presidential election. And so I've had the opportunity to be in DC immediately following several different presidential elections now. And I'm telling you, it is super exciting. And it's just like that Washington Wire report that you do the day after, 2 days after the election, with all the great speculation on what's apt to happen in the tax credit industry is, I don't know. I love it. And I know so many other people do too. And so I'm really looking forward to this event. And I'm actively involved in the Wednesday primer that you talked about. And so if you guys like financial forecasts and you want more insights on this process, please come to the Wednesday workshop. I help lead several sessions on financial forecasting along with other tax attorneys and project finance professionals from the industry. And we really kind of get into just great dialogue and oversight on the various structures and the tax and finance issues related to these types of facilities. So please join me.
I also note that on that Wednesday, we're going to have an Opportunity Zone Summit, and there is a good amount of Opportunity Zones investment in renewable energy. So if you're interested in that, please join us there as well. So Tony, let's turn now to our off mic section, which is a fun segment that you recommended and we adopted, and we're having a lot of fun with it, where we get to acknowledge our industry colleagues with shout outs. Tony, what's your industry shout out for this week?
Thanks, Mike. I'm excited to give a shout out to my friend and our industry champion, Abby Hopper, President and CEO of the Solar Electric Industry Association. Abby is a great champion of renewable energy, especially the solar and battery storage industries. Abby works tirelessly to advance the clean energy industry, and I, along with the rest of the industry, owe her a debt of gratitude.
And I do as well. So I'll give a shout out to Abby Hopper as well, and particularly for what she's going to be doing. Once we have the election results, I know that she'll be very busy in the fall, in the weeks, months, and years ahead, preserving what we were able to achieve through the Inflation Reduction Act, as well as expand the resources that are being dedicated to clean energy. So thank you very much, Abby. And thank you, Tony. And also to our audience, I'm Mike Novogradac. Thanks for watching and or listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.